Hello, everyone, and welcome to this episode of 𝗖𝗄𝘗 Interviews. My name is Andrew Wu, National Director of the Junior Economists. I will be your co-host for today's episode and joined by my fellow co-host,
Vasu Bhardwaj, and I am the Head of Operations and Junior Economist. Today, I have the great honor and pleasure to be joined by Mr. Lascelles, the Managing Director and Chief Economist for RBC Global Asset Management. Thank you so much for joining us today and taking out the time. It's a pleasure to talk to you.
Oh, it's my absolute pleasure to be here. It's been fun learning a bit about what this group does and happy to answer your questions.
Yeah, for sure. And I know a lot of our viewers and listeners will be happy to hear about your experiences, especially in these turbulent economic times. But before that, do you mind if you just tell us a little bit about yourself and kind of your overall professional journey?
Sure, absolutely. So as you said, I'm the chief economist for RBC Global Asset Management. So that's sort of the investment wing of the Royal Bank of Canada. So we run the mutual funds and the ETFs and so on. And we're all sorts of really smart people here. But one of the inputs we use in terms of trying to make intelligent investment decisions is to have a little team of economists. And so I'm the leader of that team. And so we're trying to get a read on what's going on in the economy, ultimately of relevance to markets, and so assisting in decisions like should we be buying stocks or bonds, or should we be investing in Canada or Germany, or those sorts of things. And I think the average person often thinks it's all about economics, and if you can get that call right, you've got your investment decision sewn up, and that's not quite the case. In part because, of course, there are other important considerations: the valuation of the stock market, there are technical trends, and this sort of thing. For that matter, and this makes me very sad to say, but it's hard to get the forecasts exactly right, and the consensus is pretty smart, and so the amount of alpha that we can add is a little bit, but it's still worth pursuing. And so my main job is to advise portfolio managers who are trying to pick what stock and what bond and what sort of countries to be investing in. And then I guess you could say a secondary part is maybe more of an education or a marketing capacity, which is I get to make presentations to clients and to prospective clients and to other groups, including in this case to you. And I should say, in terms of what makes me like economics, I think that was maybe part of it as well. Well, gosh, I mean, I love that it's so connected to the world around us, particularly right now, to the extent that, of course, unfortunately, there are some pretty big economic threats right now, at least in the form of tariffs. And so it's nice to do something that feels quasi-relevant to the world around us every once in a while. It's also a nice way to try and understand the world. As much as it's difficult to predict the future with any kind of precision, it's nice to at least have a sense for maybe why things are happening and why things are relevant, and so on. And then I will say, and this is true of economics, I would say beyond necessarily the realm of macroeconomics or of financial economics, which is maybe the portion that I'm most in. But it's a very varied profession and quite a varied subject matter as well. And so I get to do a lot of reading and a lot of writing and a little bit of math and quite a bit of econometric modeling and, of course, some public speaking, including this. And so I would say it's probably more varied than a lot of jobs, which is quite attractive. And I would say economists are still held in reasonably high esteem. We'll see how we hold up through these tariffs and beyond, but nevertheless, there is a level of esteem, which of course is nice and gratifying. And I would say as well, being a good economist, you have to be curious, and it rewards curiosity, and that's sort of a fun thing because a lot of jobs, of course, you're really very narrowly focused in on something, and so this is one where you can say what might be important or interesting next year, and then my job is to go and try to figure that out. And there are downsides. It's hard, as I said, to predict the future. It's a little frustrating when you're a macroeconomist that your knowledge base erodes incredibly quickly, right? I could talk till I'm blue in the face about the latest jobs number, and then no one's going to care the next month because there'll be another one again. So there's a lot of scrambling in some cases just to stay in place. But overall, it's interesting. I'd like to think it's relevant as well.
For sure, that's really great to hear and know about. As a student trying to pursue economics and finance myself going forward, it's really nice to hear about what I may sort of be expecting in the profession. And that bit about curiosity and the breadth and depth of your work certainly does sound very fascinating. It's something I'm also very interested in. So thank you, Mr. Lascelles, for sharing that. But without further ado, let's dive into some recent events in economics right now then. And there is quite a lot to discuss, but let's start with the threat of US tariffs. As you did mention multiple times just now, it is, I'm sure, on top of many people's minds. And so let's just get started there.
Yeah, to kind of segment off into our question and answer segment, our first question kind of is based around, as you would know, the Trump administration recently imposing significant tariffs on Canadian imports. And there was actually news today when this interview is being recorded about a conversation with Carney and Trump in regards to the future outlook of how these tariffs might come into play, including most recently 25% tariff on most goods and a 10% tariff on energy. Now, how do you anticipate these measures will kind of affect Canada's GDP and key industries, both in the short and long term? And what effect can consumers see on a day-to-day basis?
Yeah, no, it's a great question. It is the burning question that we are trying to get right. I have to say it. And so I don't know how quickly you turn this around and get this out to your audience or not, but there's a distinct risk of looking foolish to the extent that, of course, there could be some big events early next week. Tuesday, Wednesday, Thursday are all set to be potentially relevant days in terms of reports and tariffs and announcements and so on. And so we'll see exactly what comes. I've been in this business long enough to know that it's, again, hard to get the future exactly right. And I've looked like a fool a few times already over the past few months, and then looked quite smart the next day, and then sometimes like a fool the day after that. There's been a lot of sort of ebbing and flowing of tariffs. And so I don't know with precision what's going to come, but I must say, unfortunately, it does seem as though there are likely to be some pretty significant tariffs levied next week on April 2nd, I guess, in particular. And not great, obviously. And so in terms of what might be levied, well, in theory, the 25% tariffs you just cited on Canada have been delayed until that date. And so I would think some form of that will arise. I think we're all hoping maybe it gets scaled back a little bit, but nevertheless, some form of that. Indeed, I think Trump has talked about a dirty 15. So I think a lot of countries are potentially going to be hit with tariffs or at least threatened with them next week. And so that's going to be relevant in quite a number of directions. And of course, we've seen the stock market express some measure of concern about that in recent weeks as well. And I'll just say it's hard to get it exactly right. We're working with the assumption, and we're ready to be wrong, but we're working with the assumption there are going to be, unfortunately, some pretty big tariffs that come in the near term. We're hopeful and indeed assuming that there will be some scope for those tariffs to be partially unwound at some later date after negotiations have occurred. And whether that later date is 2 days from now or 6 months from now, or, in the case of the first Trump term, 14 months from now, that's how long it took to reach some sort of deal and get the original steel and aluminum tariffs off. I think it's an open question. But nevertheless, we think pretty big tariffs, unfortunately, which are, of course, quite damaging. And then hopefully the scale of damage can be reduced later. But we're not working with the assumption that tariffs can be avoided altogether. And of course, there are already steel and aluminum tariffs in place right now. And so in terms of the economic effects, unfortunately, potentially quite large. The U.S. is a big customer of Canada. And so you can say quite literally more than 20% of what Canada produces is consumed directly by Americans. So a fifth of the economy is U.S. demand. Now, no one's talking about a fifth of the economy going away. We will continue to have likely quite substantial trading relationships with the U.S., but it is being impeded. And so a tariff, of course, just creates a barrier and increases the cost of goods that are being imported into a different country. And of course, to the extent that Canada is reciprocating, which is a bit of game theory, which is a different, branch of economics, but nevertheless, of course, that actually does increase the damage. And the strategy is to encourage the U.S. to get rid of their tariffs. But so long as that lasts, of course, there's extra damage as well. And so, without a whole lot of precision, I can say our modeling would suggest if we do get something that is in the ballpark of 20 or 25% tariffs on Canada and reciprocated, the Canadian economy could grow by about 4.5 percentage points less than it would have over the next few years. And so, you're talking about a full-on recession because the economy would only normally grow at about 2% a year. And so that is a big hole and a big hole that could be created quite quickly. And so we are bracing for the possibility of an economy that could be declining in April, May, June, and perhaps beyond, depending on how long it takes to reach some sort of deal. If the big tariffs don't go away, that's the full-on recession, and we've got a big problem scenario. If it's big tariffs that are negotiated down within a quarter or two, it's still not great. And of course, you wouldn't know in real time that they were temporary. And so it would still be very painful initially, but there'd be room for some sort of rebound later in the year, and the cumulative damage would be less, though certainly still quite unpleasant. If we've got it wrong and it ends up being much more moderate tariffs, and perhaps the White House comes to its senses and recognizes the damage to the auto sector would be too great, and you just can't shift manufacturing in the kind of time frame that he's thinking, well, in that case, it's not great. It's still economic pain for sure, but it wouldn't be quite of a recessionary magnitude. But bottom line is it's quite consequential. Of course, to the average person, we're talking about a big price effect as well. And so, in fact, that is the main channel, right? The cost of things goes up. That's what a tariff does, and it encourages people to buy less and to shift their spending patterns and a number of other things. But prices go up, and so I would think that On average, again, if we got full big tariffs, on average, you think the price level in Canada would rise by a couple of percentage points. So not by 25% to be clear, right? I mean, that's just for things crossing the border. That gets that gets weeded down to some extent, but you wouldn't still expect a visible effect on prices. Indeed, I was just in a call before this with the Bank of Canada, and we were talking precisely about this sort of thing. And so, the concern that they would have and that we would have as well is, okay, the price increase wouldn't be great, but in theory, it's a one-time thing. Level goes up and then it's at the higher level, and that's that. The question, though, is whether you'd get these second round effects, and people who were shaken by the inflation shock of a few years ago would suddenly have much less confidence that inflation is going to settle back down this time, and perhaps you'd end up with companies raising prices and people making wage demands and inflation that's harder to fix, which was the problem that required rate hikes a few years ago. So we're hoping not that, but that would be an open question. And of course, all that's just the short term. I guess the long term would be, and again, only if big tariffs stick, and I'm hopeful we get some of that removed, the standard of living is just lower, right? The level of income in the country is set to be lower. Unemployment likely set to be somewhat higher. Canada would need to be trying to pivot toward other trading partners. And again, I see no scenario in which the U.S. isn't the number one trading partner. It's just orders of magnitude bigger as a share of trade than anyone else right now. And I don't think that's going away even with big tariffs. But of course, you're looking at China and India, you're looking at Europe, you're hoping to make a pivot, but it's very hard to do because trade is very geographically oriented, and the people you trade with are generally the countries that are close to you. And we have a tricky geography with mountains and lots of land, and it's sort of hard to ship many of these big raw resources that Canada produces. And there already is a free trade deal with Europe, and it's just the region is far away, and so there's not that much trade. China is making overtures, but of course it's been a prickly relationship. It's very much the same with India, and so I suspect Canada will manage to do something there, but we need to be realistic about that ability to pivot. But again, so much depends on the durability of tariffs, and just keep in mind, as much as we do need to deal with the reality in the short run, I deal with investors all day long. We're all trying to be long-term investors. And of course, long-term investors can usually afford to look through political events because usually it's one president for 4 years and then you're on to something else. And if there's bad policy, the bad policy has an opportunity to be unwound later. I can't speak with any kind of precision about the year 2028 or beyond, obviously, at this juncture. But as much as we do need to talk about a changing world order and the U.S. seemingly engaging in some isolationism, and I think that has been a trend that's been afoot perhaps for a while in some more subtle ways, equally, we shouldn't overreact and presume that the U.S. is just checked out from global affairs forever. And so let's not overreact over the long run.
Yeah, for sure. Thank you for sharing that. That was certainly a lot to consider and to keep in mind going forward. Hopefully, of course, these tariffs do get negotiated down somehow for Canada and the world as well. And we don't see all of these negative consequences come to pass. But that's definitely a lot to keep in mind and to consider. And so in light of these current economic challenges that you just mentioned, how important is the coordination, I should say, between fiscal and monetary policies in Canada? I think you just mentioned that you were on a call with the Bank of Canada. And so we're just curious, like what steps can be taken to ensure that both policy areas work synergistically to support sustainable economic growth?
Right. Yeah. And that's a great question. It is the burning question that we're trying to get right. I have to say it. And so I don't know how quickly you turn this around and get this out to your audience or not, set my way. Distinct risk of looking foolish to the extent that, of course, there could be some big events we certainly don't want monetary fiscal policy Wednesday, at odds with each other, right? You don't want rate cuts with tax hikes and just neutralizing each other's effects and so on. And so we don't want exactly what comes. I'm always a little bit careful in terms of talking about coordination between monetary and fiscal policy just a few times already over the past few months, and then independent, and the next day, and then sometimes like a full the day after that. There's a lot of rowing and ebbing and flowing of tariffs. The economy and inflation demands. I think it'll be the way I would view it. Going to come, but I must say, without too much explicit it does seem as though there are likely to be some pretty significant tariffs at the central bank, and you worry about politicians in particular rate cuts through because they're not great, obviously, and so 4 or 5 years might be levied. Well, in theory, the 25% tariffs you just cited on subtle aside have been delayed until that date, and so significant some form of that will is weak. I'm hoping maybe it gets scaled back a little bit. Central bank response, some form I would expect fiscal stimulus. That's of course the government. Trump has talked about a dirty 15, moving in the same direction. A lot of countries. It's a little bit tricky on the central banking side because of course central banks next week, and so and more inflation. That's going to be more inflation. Usually quite a number of directions, and of course we've seen rate cuts. You can't do both some measure of time. Obviously, in recent weeks as well. And I'll just say it's hard to get a hike, and so we're working with the assumption you have this enduring wrong, but we're working with the assumption there are going to be tariffs, so that pretty big tariffs that come in on the inflation side. The price level jumps higher, but it's sort of a one-time jump higher. Those tariffs so partially unwound some later date after negotiations for a year or two occurred, and whether that later date is 2 days from now or 6 months you and I grumpy and every grocery shopper unhappy. 14 months from now, that's how long it took to reach some sort of deal and get the original theory they should be doing more. I think it's an open question. I think, but nevertheless, we think pretty big tariffs. I mentioned that just because it does actually tie their hands a little bit, and then hopefully the scale of damage can be reduced later slightly in terms of what it can achieve. And so I think that tariffs can go in the same direction. And of course, there are already non-trivial support from the central bank if right now. And so, but I think you're going to get economic effects, unfortunately, potentially quite large. Side, the U.S. is big customer clear of Canada. It's not their problem. They're quite literally on more than 20% of what Canada produces is consumed directly by Americans. So a fifth of the economy is U.S. demand. Now, no one's talking about a fifth of the economy going away. We will continue to have likely quite substantial trading relationships with the U.S., but it is being impeded, particularly, of course, meanwhile, if creates a barrier manufacturing that maybe is selling to the U.S. if you've got a big problem, you might need a different country. So, of course, the central bank Canada is reciprocating, which is a bit of game theory, which is different. Businesses are between economics, all that well. But nevertheless, of course, that actually does increase the policy might play a prominent role, and is to encourage the U.S. to get rid of their tariffs. But so long as that start by saying, and they're not giving me any secrets here, we're just well. And so, without a whole lot of precision, I can say our modeling would suggest if we do get something that is publicly known comments set my way, so no insider info on Canada, I can say we certainly don't want monetary and fiscal policy grow by about at odds with each other, right? You don't want than it would have over the next few years. Tax hikes and you're talking about neutralizing each other's effects. The economy would only normally grow at about 2% a year. I'm always a little bit careful in terms of and a big talking about coordination between monetary and fiscal policy. And so we are bracing for the possibility of central banks are independent in April, May, June, and perhaps beyond, depending on how long it takes to reach some sort of the economy and inflation demands. The big tariffs don't go away. I would view it. That's the full-on recession, and we've got a big problem scenario. It then starts. If it's big tariffs that are negotiated down within a quarter or two, it's still not politicians, you wouldn't know in real time because they're myopic and they're only around for 4 or 5 years initially, but there'd be room for some sort of rebound. Anyways, that's a subtle aside would be less. They'll certainly if we do get significant tariffs, and if we've got it wrong and it ends up being much more moderate tariffs, rate cuts, the White House comes to its senses and recognizes the damage fiscal stimulus. That's of course the government response. So ultimately moving in the same direction. The kind of time it's a little bit tricky on the central banking side because of course central banks are facing still economic pain for sure, but it wouldn't be quite more inflation usually means rate hikes, less growth means rate cuts. Bottom line is it's both at the same time. Obviously, of course, to the average person, the general theory is that you would be about a big price cut as well. And so, in fact, the logic is that right, the cost of things goes up. Economic tariff does created by tariffs encourages people to buy less. Meanwhile, on the inflation side, a number of other things jumps higher. Prices go up, and so I would think jump higher on average. Again, central banks of course target rate of on average the rate is higher for a year or two, and then it rise by a couple of percentage points. So not by 25% to be in every grocery shopper, right? I mean, that's just for things crossing the border that gets rate of inflation that gets weighted down to some extent, but you wouldn't still expect they should be doing more about the growth side. And so I think prices indeed I was just in a call before this. I mentioned that just because it does actually tie their hands about this sort of thing, and so the concern that they would have, that we would have as well, as what it can achieve. And so I think price increase both can go in the same direction. In theory, it's a one-time thing. Non-trivial goes up, and then the central bank it's at the higher level, and that's that. But I think you're going to get though is whether you get these second round on the fiscal side. People who were shaken by the inflation shock a few years ago would suddenly have much less confidence. Unemployment is going to settle back down this time, and perhaps you'd end up with companies raising prices and people making wage demands and inflation that's harder to fix, which was the problem that required rate hikes a few years ago. So we're hoping not that, but that would be an open question. And of course, all that's just the short term. I guess the long term. Meanwhile, if you're only manufacturing, maybe selling to the U.S., you've got some of that removed. You might need a lot of the standard of living. Central banks famously really can't differentiate between households or between businesses or between sectors all that well. Somewhat higher. You would think that fiscal policy might play a prominent role and pivot toward other trading partners. And again, I see no scenario saying, and they're not U.S. isn't the number one trading partner. Just giving them my views orders of magnitude bigger as a share of trade than anyone else right now. And I don't think that's probably no comment set my way. But no, no,
of
no
course, you're
insider
looking at
info,
China and
unfortunately,
India,
but
you're
I
looking
can
at
say, I
Europe,
mean,
you're
we
hoping
certainly don't
to
want
make a
monetary
pivot,
and
but it's
fiscal
very hard to
policy
do
because
at odds with
trade
each other,
is
right? You don't want
very
rate cuts
geographically
with
oriented,
tax
and the
hikes,
people you trade with are
they're
generally
neutralizing each
the
other's
countries
effect, and
that
so
are close
that's,
to you.
we don't
And we
want
have a
that.
tricky geography with
I'm always a
mountains
little
and
bit
lots of
careful in
land, and
terms
it's sort
of
of hard to
talking
ship
about
many of these
coordination
big raw
between monetary and
resources
fiscal
that
policy,
Canada
just
produces.
because
And
technically, of
there
course,
already is a
central
free
banks are
free trade deal with
independent,
Europe,
and
and
it's
it's be
just
removed, and so
the country is
you know,
far, the region is
both
far away
rowing
in
in
the
the same
same
direction
not
because
that
that's
much
what the
trade.
economy and inflation
China
demands.
is
I think would be
making
the way I would
overtures, but
view
of
it.
course, it's been a prickly
Hopefully, without
relationship.
too much
It's very much
explicit
the same with
coordination, just
India,
because it then
and so I
starts to
suspect Canada
undermine the
will manage
independence
to
of
do
the central
something
bank, and
there.
you
But
worry
we need
about
to be
politicians,
realistic about that
forcing rate
ability
cuts through because
to
they're
pivot.
myopic.
But again,
And they're
so
only
much
around
depends
for
on
4
the
or 5
ability
years,
to
and they like
tariffs.
more
And just
growth,
keep in
even if there is
mind
as
a
much
cost.
as
So anyways, that's
we do need to deal with the
aside.
reality in the short
So
run.
I mean, certainly if
I
we
deal
do
with
get
investors all day
significant tariffs, and
long.
if the
We're all
Canadian
trying to
economy
be
is weak,
long-term
I would
investors,
expect
and of
more
course,
rate cuts.
long-term
That's the central
investors
bank
can
response.
usually afford to
I
look
would
through
expect fiscal stimulus. That's of
political
course the
events
government
because usually it's one
response. So
president for
ultimately
4
moving in the
years, and
same
then you're on to
direction.
something
It's a
else. And
little
if
bit
there's
tricky
bad
on the central
policy, the
banking
bad
side
policy
because,
has
of
an
course, central
opportunity
banks are
to be
facing less
unwound
growth
later.
and more
I can't
inflation.
speak with any kind of
More
precision
inflation
about the
usually
year
means rate hikes.
2028
Less
or
growth
beyond,
means rate
obviously,
cuts.
at
You
this
can't do
juncture.
both at
But
the same
as
time.
much as we do need
Obviously,
to talk about
the
a
general
changing world
theory is
order
that
and the
you would be
U.S.
more
seemingly
inclined to cut as
engaging
opposed to hike, and so
in some
the logic is
isolationism,
that you have this
and I think that has been a
enduring
trend that's been
economic
afoot
hole
perhaps
that's
for a
created by
while in some
tariffs,
more
so that
subtle
needs to
ways.
be addressed.
Equally, we
Meanwhile,
shouldn't
on the
overreact
inflation
and
side,
presume
the
that the
price
U.S. has
level
just
jumped
checked
higher,
out
but
from
it's
global
sort of a
affairs forever.
one-time
And so
jump
let's
higher.
not
And
overreact over the
so
long run.
central banks, of
Yeah,
course,
no, for sure. And as you mentioned, apart from tariffs, there are still other economic risks that the Canadian economy faces. And the question of tariffs, especially in light of this recent administration, has really given another focus to the Canadian economy and how we can necessarily shift, whether it's our customers, but as you said, due to geographic locations, it would be impossible to rule out the US as our main trading partner. So, in light of all these different other risks as well, apart from just tariffs, what do you think in terms of these risks that we need to, as the Canadian economy, need to actively monitor and address?
Yeah, it's a great question. I'm sure I could go off in any number of directions. And of course, the mind has been so focused on tariffs and US public policy right now, it's almost hard to even conceive of other things. But of course, there are other things to think about. And so maybe I'll throw three out there. And so just very briefly, and I don't believe this to be a genuine likely threat, but nevertheless, I mean, there have been questions regarding Canada's sovereignty, right? And so that's coming from the US, and I think it's quite unlikely that there's any sort of true action taken in that direction. But nevertheless, I mean, that certainly is one of these low probability, high consequence kind of risks. And so I guess that's one just to think about a little bit, though again, I find it extremely unlikely, and we're just giving thought to that subject just in case that low probability were to become a bit more relevant. Inflation, right? And so inflation, I mean, that has not been quite fully solved yet. And so inflation has come down from the prior peak, but it hasn't fully normalized. In fact, I think we're all a little bit disappointed by the latest month of inflation data in particular. And so, there may still be a bit more work to be done there. And that issue hasn't quite been fully resolved. And so I think that's relevant to be sure as well. But then maybe the fundamental one, and this would be the long-term answer, is just Canada has a really bad productivity performance in recent years. So productivity has been outright declining more often than not over the last 5 or so years, and that's completely bizarre. I mean, I don't feel like I'm getting dumber. I'm not throwing out my new computer and finding an old computer in the trash. I mean, it's very unusual for productivity to fall, and there were some special temporary factors in part, but it's nevertheless been unpleasant. And ultimately the financial standard of living, at least for Canadians, is driven almost exclusively by productivity, and we have not made any gains. In fact, we've all probably lost $3,000 or $4,000 or $5,000 a year of income, unfortunately, as a result of the recent trend. And so it's really important to get that growing again. And then even when it's growing, the reality is that Canada's productivity growth has significantly underpaced the U.S. over the last 40 plus years. And, in 1981, Canada had 99% of the US productivity level, and today it's about 75%. And so that's, $20,000 plus a year of income that the average Canadian isn't earning. And you see slightly startling comparisons of provincial GDP per capita or wages to US states, and a lot of the Canadian provinces, including Ontario, where I live, are well behind the great majority of US states. And so productivity really is a challenge. This isn't a treaty treatise on that, and it's not the situation where we can talk for hours on the subject. But I would say, unfortunately, or maybe fortunately, it is a lot of problems. And so I say fortunately just because it means there are a lot of different little things you could do to maybe incrementally make progress. And some of it is just temporary post-pandemic shock. Some is because there was an immigration surge, and it's just hard to digest new workers quickly, and that fades with time and as some of the policies have recently changed. Some is probably cultural. I think there's maybe more of a appreciation of entrepreneurs in the U.S. and a celebration of financial success and so on. And so that's probably something that's a little slower to turn if it were ever to turn. Public policy, tax rates are higher here. I think regulations are a lot stricter here, and so there is likely room for some easing. And actually, with an election coming, it does look, regardless of who wins, as though there's probably going to be some steps in that direction. Business decision making, as much as the businesses like to blame tax rates and regulations and so on, the average capex per worker in Canada is not much more than half that of the average capex per worker in the US. It's a pretty huge difference. You can't explain that by a corporate tax rate that's a percentage point or two higher. That does not explain half the level of capex, if that makes sense. And so, productivity is going to be really, really important, and getting that going again. And I'm hopeful that, the kick in the pants that Canada's feeling right now, and everyone's being jolted awake, I think, around the world a bit right now. I'm hoping that gets things going and we can maybe get back on the right track there. But certainly that's an important issue.
Yeah, no, for sure. And I remember hearing an acronym once, comparing a lot of these risks to something similar to a flock of geese, where basically you have your head geese that basically takes on all the headwind, right? All these types of factors. And what's really happened in Canada is that head geese has fallen back and back and back, and the US has basically advanced over that head geese of being Canadian. So that's kind of to put it in perspective of a pretty Canadian symbol of a Canadian goose. But anyways, we'll be moving on to our closing segment. I know you've given us a lot of insights towards economics, but we also want you to give a little bit of a personal insight as well. So given a lot of your vast experiences, what would be one piece of advice that you would give to the next generation, whether it's getting involved in economics or just getting informed or anything?
Sure, I've got a few, hopefully not too many, but I'll share a few if that's okay. And so the first one I'll say, and when I talk to people about sometimes their career aspirations to be a Bay Street economist or some variation on that, I mean, I certainly encourage it. I have no regrets. I'm very lucky to be where I am. I do like to remind people, though, it's a pretty darn small profession, and it's a pretty small group of people. And so I don't know what the number is. Maybe there's 50 of us or something. It's tiny. And so I always tell people, listen, I like economics is fascinating. And by all means, if you can be one of those 50, that's great. But there are a lot of other professions, including in finance, which both of you, I think, have expressed some interest in, that use kind of macro insight. You're not called an economist. You might be paid more than an economist, by the way, but you're doing economic type stuff, right? And so, portfolio managers and analysts, and some of them are maybe doing more microeconomic analysis, looking at, companies within a sector, and some of them are thinking big picture. I mean, a bond portfolio manager is thinking about central banks and inflation and public debt and sovereign debt risk and all these sorts of things. And so just make sure you cast your net wide enough and don't just apply for jobs that say economist, because there are so few. And actually, there are some jobs that can, pay more, be closer to the business decision making and so on, that are there as well. So be aware of that. And it includes even being things like a financial advisor or an investment advisor or something where you're applying macro insights all the time. So I do like to remind people of that. Just cast that net wide enough because it's such a tiny community. And then in terms of other things, I mean, one would be, certainly cultivate your mind, obviously. I would say take a holistic approach. Don't forget about the body. Don't forget about your mental health and those sorts of things. I think really to be firing on all cylinders, you need to be doing all those things. So don't just focus exclusively on the academics. You read a lot if you can. I know the world has changed. There are not physical newspapers sitting around, on your parents' kitchen table anymore. And so it's easy to lose track of that. But, try and read a lot. Try and read high quality sources if you can. Don't just read, like I'm an economist. I do have to read the Economist magazine. I do have to read the Wall Street Journal and all these other things, grumbling sometimes. But read for pleasure too. Like just read a lot. That's how you learn about the world, and you develop a really good sense, and your vocabulary goes up, and the sophistication of your thought goes up, and all that is super, super useful as well. Don't underestimate how much being curious is really important to be an economist, right? Like, just think what might happen. What are some of these scenarios? You guys ask some good questions. questions today. Try and answer some of those questions and think those through. And it's like, curiosity can take you a long way. And I think that's probably the attribute that I've been able to ride the most. And a lot of it is someone asks you a question. You say, that's a good question. I'm going to go figure that one out. And so, do be curious. And I would say have eclectic interests. I mean, I would say the news source, I don't know if I'd call it a news source. The thing I like to read the most, and I feel like I get the most out of, is actually the New Yorker magazine. And so pretty rare that there's a proper economic article in there, though sometimes there is, but it's unbelievable just sort of the breadth of thought that's there. And you're getting, instead of reading a book that's 150,000 words, they're giving you a 4,000 word summary, and you've got kind of that in your back pocket. And don't focus yourself too narrowly. I guess that's the takeaway. Really, just be a curious person and embrace the world. And things work out most of the time. And then just recognize, and maybe as per the be an economist if you like and if you can, but there are other great things to do as well. Do pursue the low-hanging fruit when it comes along. Certainly, it was not preordained that I would be a chief economist. That happens to be the way the opportunities presented themselves, and I'm happy that the way it's worked out. But there are certainly scenarios in which I could have done any number of other things, and it's just when opportunities come along, you seize it, and it's amazing how engaged most people are in the work that they do. I remember once reading an editorial, and I think it was the Financial Times, and it was a journalist saying that she used to feel such pity for people doing jobs that weren't in big attractive popular spaces, and then she would kind of listen to people on the train going home in London, England, and she'd realize everybody was talking excitedly about, we're going to make this next sale, and life is interesting if you choose to make it interesting, and your interests don't have to be exactly what you do in real life. In fact, you can kind of kill it a little bit. Like, I don't really love reading the Economist magazine because I've got to check off every page and underline this and make a note of that, and so don't feel like your passion has to be exactly what you do, but nevertheless, find time for that passion. And if you can marry the two, obviously, that's just fine as well. How's that for an eclectic set of thoughts?
Yeah, for sure. Advice. As high school students ourselves, who's just entering post-secondary perhaps, or many other of our audiences who are still considering what they want to do, where they really want to go in life. I really believe that it's important to keep your mind open and just consider all of these different potential pathways they can go, as you mentioned just now. And also just taking care of your mind and body, I think is also very important and something I can relate to. So thank you for that. And that actually does bring us to an end to our conversation today. Mr. Lascelles, thank you so much for your time and effort. We really appreciate you taking the time to be here with us and for sharing all of your invaluable insights. We've really learned a lot about where our economy may potentially be headed, what things to look out for, and what we really need to keep in mind going forward. And I'm sure our audience has as well. So thank you everyone for listening. Thank you, Mr. Lascelles, again for sharing all of your thoughts. And that brings an end to our episode today.
Thank you so much. Good luck with your studies and with your future careers.